Hello, welcome to the fourth in our series of bite-sized webcasts on management commentary. I'm Joan Brown, a member of the Management Commentary project team. In this webcast, I'll be discussing the concepts of key matters and materiality and how they could work together to bring focus to management commentary. The IASB has published proposals for a comprehensive new framework for preparing management commentary. If you've watched the first webcast in this series, you'll know that the board is proposing this new framework to respond to investor calls for better information. One of the things investors are calling for is more focus on what is important. Investors have told us that management commentary doesn't always focus on the information they need to make assessments of a company's prospects. In other words, material information. There can be too little information about really important matters that could have the greatest effect on the company's prospects. And sometimes the information that is included about these really important matters is hidden amongst information about less important matters. Another frustration is that management commentary can contain too much generic information that investors can get elsewhere and doesn't help them understand the implications of the matter for the company itself. We know it's difficult for preparers of management commentary to decide what is material, and that they sometimes feel obliged to report everything about anything that could possibly affect the company's prospects. For that reason, the IASB's proposed framework includes a package of measures designed to bring more focus to management commentary, helping preparers provide information that is material and, just as importantly, omit information that's not material. First, the framework would include requirements to disclose information that meets specified disclosure objectives, which are designed to reflect investor needs. These disclosure objectives are discussed in the third webcast in this series, and they cover the areas of content shown on this slide. Secondly, the proposed framework emphasises that companies need disclose only information that's material in the company's specific circumstances. And material information will be defined in the same way as it's defined in IFRS standards, from an investor perspective. The proposed framework also includes guidance to help management make some of the trickier materiality judgments. For example, in relation to highly uncertain future events that might affect the company, but only in the long term. However, we know that even with such guidance, materiality judgments for management commentary could be challenging, so the proposed framework would include a third important tool to bring more focus to management commentary. This would be a requirement for management commentary to focus on what the framework calls key matters, and defines as matters that are fundamental to the company's ability to create value and generate cash flows for itself and hence for its investors and creditors. The second webcast in this series talks more about value creation. Because key matters are fundamental to the company's ability to create value and generate cash flows, it's likely that there'll be matters that management monitors and manages, and that the information management uses to run the business will be the source of much of the information that needs to be included in management commentary. Key matters are also likely to be pervasive, relating to more than one area of content. Let's consider, for example, a company in the business of fashion retail. A key matter for the company might be changing shopping patterns. A key feature of the company's business model could be the current size and nature of its online business and the age mix of its customer base. Key factors and trends in the external environment could be the increasing trend towards online shopping and the growing influence of social media on the shopping patterns of young adults. Key aspects of management strategy for developing the business model could include plans and targets for developing the online business, for example, for upgrading the company's website and warehouse facilities, for building lasting online relationships with its target customer base, or for closing underperforming stores. Key aspects of the company's financial performance for the period could be the amount it has invested in social media marketing or the revenue it's generated via click-through links on social media. Let's now look at some questions people have been asking about the concept of key matters. Some people have asked us whether key is a disclosure threshold, and if so, how it would interact with the materiality threshold. Should companies disclose material information or key matters? The answer is that the only disclosure threshold is materiality. The requirement to focus on key matters isn't a disclosure threshold, it's instead a tool to help preparers of management commentary identify material information and enable them to draw that information from the information they use to run the business. If management judges that a matter, like a change in shopping patterns, is key for a company, it's likely there will be company-specific information about that matter that's material to investors. And as most material information will be about key matters, the framework proposes management commentary should focus on these matters, providing material information about them. To illustrate how key matters and materiality would work together, let's go back to our fashion retailer example. In this example, management has identified its strategy for developing the online business as a key aspect of its overall strategy. So it would include in its management commentary material information about that aspect of the overall strategy. Material information could include, for example, growth targets for the online business, or metrics measuring progress to date in upgrading the company's warehouse facilities or in closing high street stores. Some people ask why the board is introducing the concept of key matters for the management commentary framework when it hasn't used that concept in IFRS standards. The answer to this question stems from a difference between financial statements and management commentary. Financial statements report a finite population of matters, the financial transactions of the company, and other events that create assets, liabilities, income, or expenses. And each IFRS standard applies to a subgroup of those transactions or events. Essentially, the scope of each IFRS standard identifies the matters about which a company should provide material information. For management commentary, it's different. The scope of management commentary isn't so clearly defined. There's an indefinite range of matters that could affect an individual company's prospects. So the concept of key matters is needed to narrow down that range of matters to those that are really important to investors. Those of you familiar with the IASB's conceptual framework might know that it talks about financial reports providing information about economic phenomena. The first step is to decide which phenomena should be reflected in a financial report, and the second step is to decide what information should be provided about them. IFRS standards specify the economic phenomena to reflect in financial statements, but it's not possible to specify the phenomena to discuss in management commentary because the range of phenomena that could be important to a company's prospects is so broad. The notion of key matters is designed to help management decide which phenomena to discuss. It's also worth noting that the existing IASB practice statement on management commentary already incorporates key matter type notions, but using a variety of undefined terms. For example, it asks for information about the company's main markets, its most important resources, its critical financial resources, its principal risk exposures, its significant relationships, and so on. The new framework would make application simpler by using just one term, key, and by defining that term. An interesting question is whether there could be material information that doesn't relate to a key matter. The answer is that yes, there could be. For example, suppose most companies operating in a particular sector have significant exposure to a particular risk. Investors might expect that risk to be a key risk for all companies operating in that sector. If a company doesn't have significant exposure to that risk, a statement of that fact, an explanation of why it is not a key risk for the company, could be material information. Finally, some people have questioned the terminology. In particular, some have suggested people might confuse key matters with key audit matters, a term now widely used in independent auditors' reports to describe the matters that the auditors have judged to be most significant in their audit. I think that's an interesting observation. the board will want to find the clearest term possible for the concept of key matters. If people tell us that the term key matters is potentially confusing and can suggest better alternatives, the board will consider them. The board will welcome views on its proposals relating to key matters, and indeed on all aspects of the proposals in the draft framework. The comment period ends on the 23rd of November, and if you'd like to submit comments, you can do so via the Management Commentary project pages on the IASB website. In the meantime, I hope this webcast has been useful to you, and I hope you can join us for other webcasts in this series to hear the answers to frequently asked questions about other aspects of the proposals. Thank you for listening.